In San Francisco, and this is Bloomberg Technology. Coming up in the next hour, the tech wreck sends stocks sputtering. Amazon and Alphabet among the companies getting pummeled after their latest results fall short. Plus, turning the Windy City into another Silicon Valley. Can Chicago be America's next tech hub? We'll talk to a former U.S. Commerce Secretary who's betting on it. And companies across all sectors are making a commitment to workplace diversity. But is progress really happening? A new Women in the Workplace report seems to prove otherwise. But first to our top story. When it comes to wild price swings, the tech giants are all the action. Tech has been front and center in the global equity sell-off. Wednesday, the Nasdaq lapsed into corrective territory. However, now it is on pace for its fourth consecutive weekly decline as Amazon and Alphabet led shares lower post-earnings. To break it all down, we are joined by Luke Kawa, our Bloomberg cross-asset reporter. With me here in the studio, we've also got Bloomberg Tech executive editor Tom Giles. So, Luke, talk to us about what you're seeing here in the tech part of this sell-off. Are there signs this will be lasting?
Well, one thing that I think is a big concern for investors is the fact that really nothing is holding up among the big weights in the Nasdaq 100. Everything's off at least 5% from the S&P 500's high, save your Apple and your Microsoft and your Intel and also Comcast. So there's a lot of damage, very widely spread. And one thing, this is a time where we're supposed to be talking about and treating companies on an individual basis in the market. It's a time when realized correlations are supposed to be falling. That's not happening. In fact, realized correlations are near their highs of the year for the Nasdaq 100. So they're all being painted with the same brush, and that brush has generally been downwards. What is cause for concern is that even if you do perform well in terms of earnings growth, even if the big concern is really that you're not willing to pay as much for earnings as tech as people used to be. And then you look at price to earnings forward ratios. Well, it's come down for the Nasdaq 100, but the premium to the general market, it's still at what would be its highest point in 2017 and higher than any point in 2016. So if this sell-off is really about, well, we're not sure about tech's earning power and its ability to out-earn the market, especially with the big names, then tech can get a lot worse. And if tech gets a lot worse, then the market gets a lot worse.
Tom, let's dive into some of the specifics, because if you look at Alphabet, the miss was narrow, right? And still, it's getting punished. Why?
Companies around the world would die for some of the growth rates that companies like Amazon get and are still getting and will get in the future based on their forecast. But remember, this is a company that has been outperforming on one level or another quarter after quarter after quarter. And if it doesn't really outshine expectations in a big way, and that's certainly what's happening right now, there's going to be some disappointment. The other thing that people are focused on is spending on the cloud, right? And so Western Digital is a good example of that. They had numbers out today that suggested that this breakneck spending that we've seen, this investment in the cloud that's been fueling businesses for Amazon and Alphabet, for example, for a long time, also potentially could be slowing down. So there's a couple things that are giving people a little bit of pause. When you combine that with concerns about the macroeconomy, rising interest rates, it's all conspiring to give people reason to sell off the technology industry.
Luke, some big earnings coming up next week. Apple and Facebook. Apple also has a big hardware launch event. We're expecting new iPads, new Macs. What are we watching for there?
I think we're watching for a lot of you can say whatever you want about this earnings season. It's all going to be about the outlook. For Facebook, I think it's particularly important in that, you can't make the same mistake twice. So if Facebook, after kind of really taking us in on revenue, is going to show some weakness on that front again, I think that would be perceived very badly. And then on margins for Facebook, that's going to remain key. If they are cleaning up the news feed, well, are they able to charge a premium for what ads that they do have there still is the environment and the desire to be on there and to grow the Instagram platform and ads. How is that panning out? I think that's going to be big for investors. The ability to show top line growth in an environment where we are talking about slower global growth, because that's at the heart of this sell-off. The idea that, hey, tech is economically sensitive.
Tom, Facebook had another press briefing call this morning. These are becoming a regular thing, it seems. This time, they're announcing they are removing 82 pages, accounts that are demonstrating this quote-unquote inauthentic behavior. As they describe it, all of these particular pages going back to Iran, and they say some of them go as far back as June 2016. Feels a little bit incremental, but all part of the bigger issue as we head into the midterms. How much is this going to impact the market reaction to Facebook?
They're going out of their way to send a signal to the public, to the market, to anyone who will listen. We are cleaning up our act. We are rooting out fake accounts. We are doing the best we can to limit fake news, hate speech. We're cleaning up our act. That is a message that is crucial for Facebook to bring across, again, to the public who feel like it's not a safe place, it's not a reliable source of information, to advertisers who are asking the question, is this really the best place for me to get my message across? Is it going to be effective if I spend my money here or if I look elsewhere? And certainly to Wall Street, which is asking the question, is Facebook as valuable of a property as it used to be for so long?
Meantime, Luke, the cryptocurrency market has been listless, I believe is the word we've used. How does that play into this?
I think mercifully it doesn't. The fact that you've had even the chip companies emphasize that less of this growth or less of activity is really related to this. I think the Bitcoins and the cryptos of the world have shown that even though they might be an anti-correlated or an uncorrelated asset tech, they're not necessarily providing enough cushion in bad times. I don't know how much stability in Bitcoin is going to drive further adoption in terms of its use as a payment system. I think that's kind of been the hope, that a currency has to have a store of value. And now with volatility going down, realized vol in Bitcoin is below tech. I think Bitcoin's a lot more fun when it's going crazy and people are talking about it more and activity in the space is a lot more than when it looks something more like a currency.
All right, Luke Kawa for us, our cross-asset reporter there in New York. Tom Giles, as always, thanks for joining me here in the studio. I do want to get to another earnings story this week, and that is Tesla. Oracle founder Larry Ellison says he believes in Tesla and his friend Elon Musk. Ellison went off script during an analyst meeting to bring up the electric car maker and its CEO and said Tesla is his second largest investment, but didn't provide more specifics. Ellison also criticized media coverage of Musk and said he feels that Tesla, quote, has a lot of upside. Joining us now to discuss, Bloomberg's Craig Trudell, who covers the auto company. Tell us, Craig, what do you think Ellison's endorsement means here?
Well, we knew that Ellison and Musk were close, and actually Ellison's name sort of popped up during all of this go private drama as somebody who sort of played a role of sort of brokering meetings between Musk and the Saudis, who obviously played a huge part in Musk sort of justifying why he claimed to have funding secured. He thought he was able to do that because of the Saudis' interests. But we also just heard from Ellison last night talking about, in addition to the comment that you mentioned about seeing a lot of upside, just talking about the idea that that Tesla has figured things out. The Model 3 being a huge hit in his view, talking about the idea that Tesla was able to do more in revenue with that one car than any other car in the U.S. market in the third quarter. Those all are sort of echoes of talking points that we heard on the Tesla earnings call. So clearly he's hearing from Musk. He talked about going through the factories and being really impressed with the Gigafactory and the Fremont plant as well. So clearly he's paying close attention and he's got a lot of money at stake here.
And Tesla's earnings were extraordinary, profitable quarter, free cash flow positive. That said, the negative media headlines are continuing. There's just one that crossed from the Wall Street Journal that the FBI is reviewing if Tesla misstated Model 3 production. What can you tell us about this?
Right. So this stems back from a report that we had in mid-September about the Justice Department looking at some of the comments that Elon Musk made about where production was going to be for the Model 3 during the course of 2017 and how that sort of checked out against what Tesla actually did. So in the lead up to that car even going into production, you heard Musk talk about them being able to make thousands of cars a week at different points in the year, and putting out big numbers for where he thought they could be at the end of the year. And in the end, they really struggled to get that car off the ground. So you saw they never came close to sort of the expectations that Musk put out there. And that obviously is something that didn't sit well with those who are skeptical of this company because there was such a run-up in the shares with all the enthusiasm about the arrival of this car that they said was going to be $35,000. And here we are today, and there's still not one that can be bought for that price. So you do have this sense, there are all these negative headlines and these real critics of this company, and this is part of it, where you have this sort of pattern of Musk coming out and making big promises and oftentimes coming up short. Not only is that something that's attracting a lot of attention from the short sellers, but it also attracts increasingly lately some attention from regulators as well.
All right, Craig Trudell, we're going to continue to follow those headlines. Bloomberg's Craig Trudell, thank you so much for weighing in. Coming up, the genius behind the Genius Bar, where the architect of Apple Retail and former JCPenney CEO Ron Johnson thinks commerce is going next. And if you like Bloomberg News, check us out on the radio, listen on the Bloomberg app, Bloomberg.com, and in the U.S. on SiriusXM. This is Bloomberg. When Ron Johnson first introduced the idea of Apple's Genius Bar to Steve Jobs, he recalls the Apple co-founder saying it would never work. Today, the product setup and education service is arguably the centerpiece of over 500 Apple stores worldwide. The Genius Bar revolutionized retail with companies like Microsoft, Amazon, all developing their own setup and training services in its footsteps, and Johnson himself has continued to rethink the sector. After leaving Apple, he went on to serve as JCPenney CEO before founding Enjoy, a tech support startup that brings product experts right to your home. He's with us here in the studio to talk about all of it. Great to have you back here on the show, Ron. So you've architected the Apple Store strategy that still exists today, but of course it has evolved. How do you think it has changed, for the better and for the worse?
Oh, I think it's gotten much better. I think Angela and the team are doing a phenomenal job. I think the stores are operating better today than they did when I was there because they continue to innovate. But it's more like Apple. Apple innovates so deeply inside things that sometimes you don't pick it up. But today they don't have a Genius Bar, they have a Genius Grove. It's like a place it's much more comfortable, if you will. They've got Today at Apple with all of these programs throughout the day to learn more. So the fundamental vision we had, which was to create a place to belong, they've just brought up a notch. And so I'm really proud of the team.
Is it getting harder, though, because the phones are becoming more incremental? It's not about, these huge technological shifts happening. It's these more incremental shifts and convincing customers to upgrade even though the phone they have may be working just fine.
It is if you think about the hardware. But the fundamental change in these phones is what happens on the inside through software and through engineering, whether it's on cameras. And that's the kind of thing that you have to spend time to learn how to take advantage of. And that's what we do at Enjoy, and I can talk about that later.
So, there's a big Apple event coming up, another, hardware unveiling, iPads, Macs, etc. But other big hardware plays like HomePod haven't really panned out.
Yeah.
What do you think will be Apple's next big hardware thing? Will there be one?
I don't know. It's you got to remember, these products are never overnight successes. The iPod was launched in 2001. It was for Mac only until 2004. In 2004, when it went to Windows, it became this thing you couldn't find in the stores, right? It's true with all of these Apple products, like the watch. The watch today, the new watch, is really a game changer. It's led for health. And you can't even get those in the stores. They're out of stock. It's really hard to do. So you got to be patient with Apple because they really deliver a product, refine it to make it perfect. So I don't know what's next, but I'm excited for next week's announcements.
So, Enjoy, you've got product experts going into homes, helping with setup. It's sort of the Best Buy model, but Best Buy is huge. How do you compete with something?
Well, it's really not at all like Best Buy, and it's really not about an expert to the home. It's really about the next frontier for shopping. So the way I think about it, up until the early 90s, the frontier was a physical store that we went to. The Apple store in Regent Street has had, in London, the same landlord for 1,000 years. We've had this 20-year time of online shopping, which is you order on a device, it's delivered to your door. Amazon leads that. It's about convenience. I believe the next frontier is going through the door. So Enjoy has created an on-demand mobile retail store that we operate for partners like AT&T, Google, Sonos. So it's really bringing like the best of an Apple experience right into your home.
Amazon is now doing some of these in-home services, a variety of in-home services. Is that a threat?
No,
to
because
Apple?
what Amazon, no, I don't think so. Amazon's very innovative. What they will do, you can order an Amazon person to come to the house and talk to you about what you might do next. And then you can order a product from Amazon and they'll ship it to you. What we do at Enjoy is we bring a mobile store. We have products you can try, you can buy on the spot, we'll set them up on the spot. It's basically everything you do in a store is now done in your living room.
Would you ever want to sell to Apple?
I just want to build a great company.
So I have to ask you about what's going on in the more traditional retail space, you know, with Sears going into bankruptcy, having been the CEO of JCPenney, now Sears is just trying to prevent the liquidation of its stores.
Sure.
Is that a futile effort?
It's hard. You know, the retail world, we're overstored. And if you don't keep your model updated, it's going to get tired. You know, I'm really proud of where I used to work, Target. Target's kind of back to being Target again. They're performing well. They figured out how to use their store and their online store, make it work together. They're an example of an older retailer that stays young. Unfortunately, a lot of retailers don't evolve or adapt well. That was one of Sears' big problems, one of Penny's big problems, is they're kind of stuck in that old business model.
Well, and you tried to do some of these things at JCPenney's and it didn't work out so well. They
Correct.
now have a new CEO. You know, are they next?
No, I think they've got a good enough balance sheet to have a chance to survive for quite a while.
If they do
and I
what?
hope they do. Well, the nice thing is they've got a female CEO, first time in 110 years of that company. And I think that's a really wonderful thing. And I know the team, when I work there, they're very committed to succeeding. And so I wish them the best, but they're going to have to evolve a little bit. They've got to find a way to appeal to a younger family. You know, the old people like me, we don't buy that much. It's young parents like you with 3 kids that are going to the store and getting kids' clothes and outfitting your house. So if you can't appeal to a young family, your future is going to be pretty tough.
And you're competing with Target, apparently. All right, Ron Johnson of Enjoy. Thank you so much. It's good to have you back here
Great to
on
see
the
you,
show.
Emily.
All right, our conversation with Intel's interim CEO and CFO, Bob Swan, how the trade war with China could signal headwinds ahead. And Bloomberg Tech is live streaming on Twitter. Check us out at Technology, and be sure to follow our Global Breaking News Network TikTok on Twitter. This is Bloomberg. Intel reported a strong and surprising quarter, igniting optimism that the PC market is back. But with the trade war with China looming, the report also came with a warning about impact on the chip industry to come. I caught up with interim CEO Bob Swan and started by asking if a healthy PC market is here to stay. Take a listen.
What a fantastic quarter for our client business. In a market where PCs, for the second quarter in a row, we've seen 1% to 2% growth. And our client business grew 16% in the quarter. So it's a testament to our team's ability to execute and deliver differentiated product for customers around the world, but particularly for our business customers. It's been a fantastic quarter for the team, which will be a fantastic year overall for our PC business. It's amazing what we're able to accomplish with a modest bit of growth in PCs. Real strong performance for us.
Do you think this kind of growth in the PC market is sustainable and will continue?
You know, we've been through 6 years of roughly 5 to 6% unit decline per year. What we really think going forward is some stability in PCs. I don't believe we'll get back to accelerating growth rates, but real stability in the PCs and our ability to segment the market and sell up allows us to grow our revenue faster than unit volume. So it's been a pleasant surprise for us this year, and we're looking forward to stability in our PC business because the profitability we generate in a stable market is very powerful.
On the call, you mentioned you think you might feel some headwinds from the trade war in China. How much of a concern is this?
You know, it remains to be seen. China's a really important market for us, Emily, and free trade is really important for our business, for our industry. So for us, we've really seen no impact as of yet, but this third wave of tariffs could begin to impact the cost of computers and for PCs. So what we've been doing with our very sophisticated global supply chain is working with our customers and our footprint around the globe to be in a position to mitigate the potential impact that any kind of tariffs could have on the demand for servers and PCs around the world.
Now, you've fallen behind Moore's Law with your forthcoming chip manufacturing technology, the 10-nanometer technology, and your competitors are right on your heels. The timeline has been delayed, and you've said that delayed timeline still stands. You know, how concerned are you about the competition?
Well, I think what's most important for us and for our customers is product leadership. And product leadership is a function of architecture, design, packaging capabilities, and process leadership. And as we look through 2019, we believe we'll continue to have significant product leadership both on the PC side and on the server side. So the ability to get more and more performance out of the current 14-nanometer node and to expand the feature set enables us to go through 2019 with a great lineup of products across both of our businesses, but also the time to get our 10-nanometer process manufacturing up and running, so we'll have products on the shelf for the holiday season in 2019. So for us and for our customers, it's all about product leadership, and process leadership is a component of that.
Intel interim CEO Bob Swan. Coming up, for years, Penny Pritzker was President Obama's right hand on commerce. Now she hopes to turn the Windy City into the next Silicon Valley. That is next. This is Bloomberg. This is Bloomberg Technology. I'm Emily Chang in San Francisco. Chicago, home of the Cubs, the Bears, and the Blackhawks, affectionately known as the Windy City. It is the third most populous city in the United States, as well as the third largest metropolitan economy in the country. But if Penny Pritzker has her way, it will soon be known as one of the world's top tech cities as well. Pritzker, who is the chair and founder of PSP Industries and was the Secretary of Commerce in the Obama administration, is leading an initiative called P33 to try and put Chicago up there with the likes of Silicon Valley. P33 currently boasts a roster of 120 pro bono committee members who are leaders in tech and business, and they've set themselves an end date of meeting this goal, the year 2033. I'd like to welcome Penny Pritzker back to the program, where she joins us from, you guessed it, Chicago. Also, former Commerce Secretary of the United States, Secretary Pritzker, thank you so much for joining us. Why hasn't Chicago, with everything that is thriving there, become a tech hub yet? And what makes you think this can change that?
Well, our new P33 effort is really exciting because it's a private sector effort, as you said, of about 150 leaders from established businesses, from tech companies, from our universities, from our nonprofits, and our civic committees have joined together to really work to on the issues that are facing Chicago. We have extraordinary assets in our city, 4 major universities just right within the city, whether it's Northwestern, University of Illinois, University of Chicago, IIT. We've got amazing talent. We graduate the second number of students with computer science degrees of any city in our country. We've got a lot of capital available. We've got a diverse existing economy. As you said, we're the 3rd largest economy in the country. But today, what we recognize is we're not punching at the weight we'd like to be punching at. And what we know is if we come together, we can focus on the challenges that we face.
So how do you convince tech grads, tech workers to stay in Chicago when they could easily leave for Silicon Valley or New York or even second-tier tech hubs like Boston or Austin?
Well, I think much of our talent and many of our graduates want to stay here in Chicago. The question is, are we creating enough opportunity? And in order to do that, we need to create greater bonds between our established businesses and our tech companies. If you think about most tech innovators, they're dying to have the major corporations in Chicago as their customers. We need to build bigger bridges there. We need to help more our universities commercialize the great innovations that are coming out of their laboratories. We need to do more to innovate ourselves, and all of that excitement builds on itself in order to keep more of our talent here, so that an innovator thinks, I can start a company here. I can have access to capital, I can hire the talent I need, I can build a business for the long term here in Chicago, and that's exactly what we're working on.
Chicago is on the short list for Amazon HQ2 and potentially 50,000 new jobs. What do you think the likelihood is that Amazon chooses Chicago?
I've been very involved in that effort, and I'm always an optimist. None of us know at this point, but basically that would be a great boost to our city. But we can't wait for Amazon. We're going to take on the initiatives that we're talking about in P33 with or without Amazon. And I think that they recognize all the strengths that I've pointed out, not including affordability and the fact that they can find the talent they want and need here, and that Chicago is such a great connected city. So these 2 initiatives exist side by side. There's a symbiotic relationship between them, trying to get Amazon and the P33 initiative. But we're moving forward regardless.
So, given your involvement, what are the questions that Amazon is asking? What is it going to come down to for them in making this decision?
Right now, I think they've gathered the information that they want and need, and now I think they're busy assessing it.
So let's talk a little bit about what's going on in the broader market and the broader business. Obviously, this is something that you follow very closely. We're in the middle of a trade war. What do you see in terms of the cascading impact from that on tech and business more broadly?
Well, I think the trade wars that we've initiated are very challenging on a number of respects. I mean, we're seeing growth today, but now you've got the IMF saying they're expecting the United States growth to slow next year. They're expecting global growth to slow, and they're pointing the finger at trade issues. You're seeing a number of our global manufacturing companies saying they're being challenged already by the tariffs and the trade issues that are being raised. So this is a real challenge. I'm a big believer in multilateral trade agreements. I'm a big believer that you want to have more and more of the world's countries and global GDP all operating with high standard trade agreements. And I think that one of the challenges that comes also from the trade wars is the rhetoric. And it allows us to focus on trade, which I think is an issue, but frankly, I think the bigger issue is really helping more and more of Americans adapt with workforce training to be able to take advantage of the technology opportunities that are being created. And I think the past tax bill, we missed an opportunity to incent corporations and companies to spend more and invest more in workforce training, which is, I think, frankly, a big part of the angst in America, much more so than trade is.
So let's talk about the rhetoric. the president has taken aim at Amazon directly, which might be one reason Amazon may avoid Washington, D.C. as the location for HQ2. Today, the president took direct aim at Twitter, claiming bias, in fact, calling Twitter a total blimp, because he believes that a bunch of accounts have been eliminated unfairly. You know, how does the relationship with the administration and Silicon Valley today differ from the relationship between the Obama administration that you were a part of, and how will that impact your efforts to turn yet another city into a thriving tech hub?
Well, I think one of the opportunities that we tried to capitalize on in the Obama administration was really building stronger bonds between the Silicon Valley, Silicon Alley, the fintech sectors and others, and Washington. There's a real need for greater communication and greater efforts. And for example, take what's just happened this week on privacy. You've seen the tech sector come together to say, we need more privacy legislation and regulation. And I believe privacy is a human right, and we do need legislation. And now you're seeing the tech sector saying, rather than the federated approach where you're having Europe come up with their own privacy rules, California come up with their own privacy rules, clearly China has another set of rules, India a different set, that there really ought to be more coherence in privacy rules. That requires communication that goes on between the federal government and the private sector and our tech sectors. So I think there's a real opportunity for the administration to jump on the ideas that are being proffered by the tech sector in terms of privacy. That would be a big step forward.
All right. Former U.S. Commerce Secretary Penny Pritzker, founder and chair of PSP Partners, thanks so much for joining us today from Chicago. Tesla has responded to the Wall Street Journal's report of an FBI investigation on whether the company misstated its Model 3 production information. In a statement, Tesla says it received a voluntary request for documents from the DOJ, and it has not received a subpoena, a request for testimony, or any other formal process. It says its philosophy has always been to set truthful targets. Coming up, when it comes to giant VC-led funding rounds, one of the first names that comes to mind, of course, is SoftBank, but it's not the only one out there. We'll take a look at this trend next. $100 billion every few years. That is the dream of SoftBank CEO Masayoshi Son for his company's soon-to-be many vision funds. And a giant fund like that can lead to some big funding rounds for startups. In fact, $100 million rounds are becoming more and more frequent, according to a new study by Crunchbase. The number of them per month have been on a mostly upward trend since the beginning of 2017, nearly doubling in that time frame. To talk about all of this, I want to bring in Jamie Montgomery, Managing Director and co-founder of March Capital Partners, a leading LA-based investment bank. So, Jamie, these giant rounds, is this the new norm?
Yeah, I think the IPOs have been pushed out further. Our business is no longer investment banking. We're a venture capital, so we do venture and growth investing alongside a number of these other funds like General Atlantic, IVP, and SoftBank's really revolutionized the industry by thinking big and providing large blocks of capital to both take companies private and to back large winners. So
now the future of the Vision Fund is in question in terms of whether they are going to continue to take Saudi money or not. We don't know the answer to that.
Right.
Let's say they say no, thank you.
Right.
How big an impact does that have on the Silicon Valley ecosystem, given all these companies that have taken money from SoftBank to this point?
SoftBank's made quite a few bets. I would think that there's a lot of money coming in there from China, from Abu Dhabi, from other countries around the world. So he still have a significant fund. I mean,
so you think that he could fill the demand even if without
yeah.
this sovereign wealth?
Yeah.
So we hear this talk of an everything bubble.
Yes.
Do you think we're in an everything bubble?
Yeah, well, I think right now valuations are priced to perfection and are assuming continued economic growth, continued profit growth, and you see corrections like you've had this week and today, early today. It's really a reflection on people's outlook rather than the current performance. The market's really a reflection of future earnings rather than current earnings. And there's concerns about, is growth slowing down? I mean, there's companies that reported fantastic earnings and the stocks tanked, so you kind of wonder, well, what's going on here? People are looking out a year or 2 years to see if the valuation in the future is really sustainable.
So If we are in an everything bubble, is this something that's going to pop? I mean, is this 1 or 2 years out? Is this more imminent?
Yeah, I mean,
it'll
be a softer. I mean, I think if you take a 10-year perspective or a 25-year perspective, which most people don't do, this will just, you won't even notice it. It's a blip. Yeah, if you take a 25-year perspective, you probably don't even really notice the 08 correction. I mean, so if you have a long enough time frame, it normalizes. So I think if you're caught in the moment, right now, 2015 was a real bubble. It kind of softened, and then valuations have moved up again this year, and I think they're down 10% from the peak, and you could, as long as we have this economic growth, there's a lot of wealth destruction on both sides. There's new industries being created, and there's old industries being destroyed, and so it's not necessarily a zero-sum game, but there is wealth being transferred between the new entrants and the old.
IPOs coming next year, Uber and Lyft, maybe Airbnb in 2019, maybe 2020. Do you think there'll be any surprises?
Yeah, look, I think Uber is a great company. I mean,
You think $120 billion valuation is fair?
I think they just have unlimited opportunities globally across all these different categories. I think their biggest challenge they're going to have is figure out how to allocate their assets, allocate their capital across these different businesses. How do you pick what product and what country and prioritize it? That's going to be a real challenge for that company. So that's a great company. And they have businesses inside of it. The food delivery business is a great business. That's worth $20-30 billion to stand alone. The technology team is great. That's a really exceptional business. Lyft will be a fast follower. There's other, I think Airbnb will get out. There'll be a number of software companies that get out. So I think there'll be I think it's going to be front-loaded where the success will be. Second half of next year, I don't know. The kind of bets are off, but I think the first half of next year looks pretty solid. And the marketplace isn't really on-off. It's really a filter. You have to look at it, and the really good companies can control their destiny. What we tell our companies is try and have 2 years of cash, because if you do have a correction, you just want to be able to power through it. We also look at it and say, look, if you want to be valued at $3 billion, we want you to have at least 10% of your market cap in cash. And so you've seen these larger rounds, because the valuations have gone up, but you really want to say, look, you don't want to be a $3 billion company with a $50 million cash cushion. I mean, that's that's a joke, right? Yeah, I mean, so you really want to look like a public company where you have some serious cash reserves if you're going to be private.
Good to know there are some conservative people.
I'm very conservative.
Taking precautions. Jamie Montgomery, March Capital Partners. Always great to have you on the show.
Thank you.
Thanks so much for stopping by. Well, Expedia's third quarter results beat estimates Thursday, sending shares up. The travel aggregator behind Hotels.com and Hotwire and others saw profit rise 41% to $553 million, boosted largely by its rental unit, HomeAway. The company is finally starting to see the benefits of buying HomeAway 3 years ago to compete with Airbnb. I sat down with CEO Mark Okerstrom, who says HomeAway is now entering a new stage of growth.
HomeAway has been on a huge growth tear here as they transitioned a business from a traditional listings model to a true e-commerce model. This quarter, they posted property night growth about 29% year over year. That does feel like a good level to us. It is supported by a massive industry that is gaining huge popularity around the world. And HomeAway is really starting to enter in 2019 phase 2 of its growth strategy. Phase 1 was again about taking a traditional listings business and turning it to an e-commerce player. And phase 2 is about moving more into the urban markets and expanding internationally. So we think HomeAway's got a long runway of growth ahead, and they're doing it in a balanced way. This quarter, they delivered more adjusted EBITDA than they did in all of last year. So they're driving growth at the same time as profitability, and we think that HomeAway's got a long, great run ahead of it.
Still ahead, several companies are making a commitment to closing the workplace gender gap. But how much more needs to be done? A lot, I'll tell you. That's next. This is Bloomberg. According to a new study from Lean In and McKinsey on gender diversity in the workplace, progress isn't just slow, it is stalled. Compiling data from over 462 companies with nearly 20 million employees, the 2018 Women in the Workplace report shows that women continue to be underrepresented at every level. I sat down with Lean In President Rachel Thomas and McKinsey's Chief Diversity and Inclusion Officer Lorena Yee to discuss.
Women are leaning in, and companies need to lean in now, too. So women have been getting college degrees at higher rates than men for years. Women are asking for more. They're asking for promotions. They're asking for raises as often as men, and they're not leaving the workplace. So companies need to do more. And the biggest thing is they need to treat diversity like the business priority it is. So what do you do when you want to hit a business goal? You have a compelling case, you set goals, you track progress, you report on your progress, and you hold leaders accountable. And too few companies are doing all of those things.
So, Lorena, you've been working on this report since 2012. You know, what is different about this year? Is the difference that there is no difference?
So we see that companies are stalled. That is in and of itself is finding. But what we find is that we're getting closer to understanding some of the root causes. So what companies are saying is we understand that we have a mega problem here, but help us start to break down problems that we can solve in units of 1 or 2 years. This will take 5, 10 years to actually shift a whole generation. So an example of that is tell us about the onlys. Tell us about microaggression. And also tell us whether targets work and how other companies do it, just as a couple of examples.
So you're singling out this idea of the only this year, which is about, you know, the only woman in the room and the experiences that that woman has as a result of being the only woman in the room. You know, talk to us about why it's so important to understand that experience.
Women who are onlys are having a markedly different experience than women who work with other women. They're more likely to face those everyday slights that we've all experienced, since this is a table of women where you're mistaken for someone more junior, you're spoken over in a meeting, you have to prove your capabilities over and over again. And that wears women who are onlys down. We know they feel under pressure. We know they feel isolated and on guard. And it's hard to imagine women can be their best selves and do their best work if they feel that way in the workplace.
So Square, for example, when it comes to hiring women engineers, one of the things that they do is they put women on a team with other women, which means they have a lot of teams that are only men because, you know, men still dominate the workforce. But the idea is that by being on a team with other women, they'll have that sort of camaraderie and that networking, and that their experience will be better. But it comes at a cost. Is that something that you would recommend?
I actually think it's a really good strategy. In a world where you don't have enough women, how do you make and retain and advance the ones you have? And putting them together creates a different culture for that sub-team. And it starts to tip it. They have role models, they have their own peer network, and they start to advance. Ultimately, what we know about onlys is that if you're the only one over a long period of time, as Rachel was saying, as you're pointing out, you start to feel less motivated to stay at that company, less satisfied, more interested in leaving. If you leave, that's less helpful.
But there's a compromise, right, Rachel? I mean, you are having teams of all men making decisions about other things without women on those teams.
Yeah, let's be clear. I don't think this is a simple choice. But this one and done approach of just I've got a single woman on a team or 2 women on a team, so now I have diversity, has to change. So until we get where we really need to go, which is we have more women at every level, so we're not picking and choosing where to put our underrepresented women across our teams, a good strategy is to group women together and put them into cohorts and accept or realize that that leads to better diversity of ideas on that team and hopefully better performance at that team. So then you can point out and say, look at our blended teams with a good percentage of women and look at the performance they're getting.
And building on that, I mean, the challenge is for companies, it's not a one-shot deal. You can fix onlys, but if that's the only thing you do, you probably won't have a lot of success. And so the really hard thing for management teams is you need to do 5, 6, 7 things in concert, and you need to stick with it. If this is a seasonal initiative, I guarantee you won't be any better than where you were last season.
What's the experience for women of color that you're finding?
So the experience for women of color, we saw this last year as well, it's worse. They face more barriers to advancement. They get less support from managers. They get less access to senior leaders. And of course, senior leaders are the people that open doors and get you noticed. And they are promoted more slowly.
So how do we make sure this isn't just solving for a white woman's problem, right? Because all the talk is about gender, not as much about race.
So our report focuses heavily on women of color, and this year we're looking at lesbian women as well because they are having a worse experience in the workplace, and we couldn't agree with you more. Elevating women and advancing women means all women. And actually the women who need the most support in the workplace based on all the research that we've done is Black women and making sure their voices are heard.
Now, Lorena, you are not only the Chief Inclusion and Diversity Officer at McKinsey, you also are the leader of tech hardware and services. So this is a notoriously male-dominated industry, which we cover every day. That must be an interesting juxtaposition for you.
Sure. So, I mean, it's a couple of different hits. One, for anyone in technical fields, for women in technical fields like engineering, it's harder. Being a person of color is harder. And also, it's probably worth noting, for men of color, it's not an easy road as well, or for anyone who's gay. But one of the things that's interesting is, in the tech field, if I were to put a slight silver lining on it, there is an ethos of transparency, even radical transparency. And you also have people who grow up in an engineering environment where they understand data. So I do think, on a level of hope, one of the things the report does, and I think one of the things is much more common, is to put it all out there. So as an example, there was one company where men felt that gender policies and initiatives were going to hurt them, and they were like 30% off the benchmark of how everyone else felt. And the CEO basically said, let's have a town hall meeting, let's put it all out there and say, here's what you guys said, let's explore that. Now, that's not going to fix the tech culture in one go, but I do think the emphasis on data and transparency is something that we can benefit from.
McKinsey Chief Diversity and Inclusion Officer Lorena Yee, as well as Lean-In President Rachel Thomas. And that does it for this edition of Bloomberg Technology. Next week, we are all over Apple and Facebook results. We'll be covering Apple's product launch in New York. And that does it for this edition of the show. I'm Emily Chang in San Francisco. This is Bloomberg. Have a wonderful weekend.